much money do we actually need to be able to retire comfortably and early in Australia? I'm going to share with you a couple of strategies, but also what is actually required right now in Australia to be retiring early. You might be watching this in your 20s or 30s and you think, hey, sitting on a beach at 45 is great. Or you might be at your 50s and thinking, hey, I need to secure my financial freedom, otherwise I'm going to have to rely on the pension. If you guys are interested in my thoughts, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now, as part of my research process, I go through many articles, educate myself, and then speak to a lot of people. And of course, we have our own consulting team at Search Property, and we speak to so many of you guys that view the channel and watch the channel ongoing. And a lot of the questions that you guys are asking is around, how much do I need to be able to retire early? We all have this goal of financial freedom, not having to get up on a Monday. So I thought, why not make a video about this? Because I think there's a few things that we can tweak, and I don't really want to focus on just, hey, we need to buy property and do this and do this and do this. I think there's more around mindset. So we're going to cover off both right now. Now, how much money do you need to retire early? In Australia, you can access your super between the ages of 60 to 65, depending on whether you've stopped working. If eligible, you can also receive the age pension from the age of 67. If you want to retire in your 40s or 50s, you obviously need funds to bridge the gap and sustain your desired lifestyle longer term. According to the latest figures from the ABS, most people expect to retire on average between their 65th and 66th birthday. But for those planning an early retirement, this may be too long to wait. For context, if you follow the trend, which is go to school, go to uni, get a job, you're pretty much in full-time employment by the time you're around 21 or 22. That's exactly when I started getting into full-time work officially, after I finished my uni degree. From that point, you've got another 44 to 45 years before you actually retire. Now, I know that sounds like a lot, and you may be watching this channel going, I've not known any other way. That's pretty much the norm. I think with social media exposing so many people and their lifestyles, we're sort of in this space where we want instant gratification. And unfortunately, that's just how we are as a society now, because we see people that are so much further ahead and we say, why aren't we there yet? But what you don't see is the stuff that's happened in the background for years and years and years. Take, for instance, running a business. If you start running a business today and you compare yourself to someone who started their business 10 years ago, it is completely different. Equally, if you go, hey, I'm going to start this passion project, I'm going to start my new channel on TikTok, you're starting with zero. Now, when you compare yourself to someone else, they also started at zero. And in this case, if you're in your 20s and you're seeing everyone else around you going, well, this is the norm, this is what I'm going to do, you don't have to do the same thing. In fact, so many people make the wrong decision when it comes to buying their own place, what's their first property going to look like. And the reason I keep coming back to real estate is because a large portion of Australia's wealth is all tied up in real estate. Whether we like to admit it or not, we want to buy property that we hopefully can see appreciation in. The byproduct is, yes, we can live in there. I know that if you bought a property and you said, hey, look, I don't really care if the prices go up, I just want to live in this property. There are very few of you out there that think about this completely emotionally, where you say, hey, I just want to live here, I don't care about the price. What most likely is happening is someone told you that you should get into the property market as soon as possible. That way you can see the appreciation of your wealth, and as a byproduct, you get to live in it. And that's the mindset that is really screwing up young Australians right now. Take my example, for instance. I did the exact opposite to all of my schoolmates, and now 10 to 15 years later, I don't talk to any of them. And the reason for that is because I felt like they didn't understand me. They didn't understand that I wanted the 1% life, and that 1% life meant that I needed to go and invest. And at the time, I was fortunate enough to be living at home, but I've been living out of home for the better part of almost 5 years now. And so paying rent and investing is called rent vesting. I talk about it on the channel. But so many people still, to this day, think the only way is to go to school, go to uni, get a job, buy a house, get married, have kids, and then retire at 65. For the few of you that actually want a different life and are open-minded to thinking like the 1%, let's continue. The Association of Super Funds of Australia calculates you'll need at least $72,000 per year to live comfortably in retirement as a couple, and $51K as a single person. This assumes you've already paid off your mortgage and that your investments will achieve an annual return of 6%. So let's break that down. $72,000 as a couple or $51,000 as a single person. Now, if you go as a single person, that's roughly about $1,000. And if you're as a couple, it's pretty much about $600 to $700 per person. Now, if you've got your house paid off, that's actually a really good life. Now I know some people have a lavish lifestyle, but if you actually think about it, your groceries are costing you what, $300 to $400 a week, I assume, and then you're looking at a couple of $100 left over for, entertainment and whatnot. If you've already got the house paid off, this works quite well. But how many people in today's terms are going to get to 65 and not have a house paid off? That is really scary. And the bigger question to ask is, how are you generating that income? Because let's say, for instance, you have your own house, it's paid off, you'll most likely receive the pension. But if you want to retire on your own terms and not have the government tell you what your budget is, you're going to need investments yourself. And it might be your super fund and the super's invested into a bunch of markets. If the market is giving you a 5% return, then that is what dictates how much you can spend that year. Equally, if it's going up by 10% that year, you might be able to get a large zinger box instead of just the normal one. But this is all on the basis that you have your house paid off and you plan to retire at 65. Now keep in mind, you can't access the pension until you're 67. So even if you did decide, I've got my house paid off and I want to retire at 60, you won't get any of the pension till you're 67. And in that case, you're relying on the income that your assets generate or your investments generate. And I don't know if that's going to make enough of it. Let's say, for example, you have $1 million in your super fund. Now, most people will never get to $1 million, but let's assume $1 million. If you get to $1 million as a couple, you would need to be generating at least 7.2% to be able to live comfortably according to the ASFA. And if you're a single person, you'd need that million to be returning at least 5%. So if you look at industry averages of say 7%, you would need at least $800,000 in your super account. A really good exercise for yourself right now, especially if you're in your 40s and edging into your 50s, is to calculate how much super do you have and how much you're going to end up with by the time you actually retire. Because if you can't generate $50,000 to $70,000 with your house paid off, you're going to find yourself not living comfortably here in Australia. One of the other things that I haven't really considered or talked about in this video is inflation. And inflation's been a really hot topic for the last 3 to 4 years. Now, are we going to see periods of high inflation for a long period of time? Nobody really knows. But this is why you want choice. You want to go, hey, I need to be proactive, because if I see another situation which just happens to line up when I retire, then the 7% that you're getting is not going to mean much if inflation is at 10%. And that's what some pensioners had to go through. Now, fortunately, what happens when inflation is really high is interest rates are high. And as a byproduct of interest rates being high, you probably got savings rates also high. For those lucky few oldies out there, they were able to put their money into the bank accounts and generate a higher return than in most cases you would get in the market. Again, without the volatility, which is really important at that age. ASFA says a comfortable lifestyle includes expenses like private health cover, good clothes, reliable internet and streaming services, rates and home repairs, regular leisure activities like going to the movies, the occasional takeout meal, an annual domestic trip, and one overseas trip every 7 years. You can tell this is the first time I'm reading this because every 7 years is pretty bonkers, especially if you've been watching anything online right now. You're like, everyone seems to be overseas all the time. Some people are going multiple times every year. So to be in a position where you can't travel for a 7-year period because you didn't make the right choices early on, you only have yourself to blame. And I know this is going to sound piercing, but the reality is that we can only control what we control. And if we decide that Australia is too expensive, we're probably going to have to move. But Australia is one of the best countries in the world. In my opinion, it is by far the best country, which is why I plan to live here long term. Now, I live in Sydney, which also means that it's super expensive. And that's why you have to be planning ahead. You have to be taking action early on. Now, whether that's going out there and making a budget for the first time, or whether it's going out there and getting into the right circles to have advanced strategies to really up your wealth. Now, what are some steps that you can take to actually retire early? Number one is going to be having a strong budget. I know this sounds silly for so many people, but I really urge you to look into it, because budgeting is not as simple as what you thought it was, which is, hey, income comes in, expenses go out. Look, I've got $100 at the end of the week. Happy days. That goes into my savings account. All that's going to do is that by the end of the year, when you decide you want to go on a holiday, you're going to go back to that savings fund and says, hey, actually, I did really well. Maybe I've got about $3,000 here. I'm going to use that for a trip. And now you've just gone through the whole year only to end up into the same exact spot. Now, if you're someone who's renting and hasn't got any investments, you're the one that really needs to start making moves. Because if you rent and you invest, rent vesting is actually really useful. In fact, that is probably a better strategy than just buying your own place. But if you're someone that rents and has no investments and you take advantage of the fact that, hey, I don't have a mortgage, I don't have these things, that means I've got more disposable income to use on my lifestyle, you're going to find yourself in really deep trouble later on. So in that case, you're better off just having your own property because chances are it will outperform inflation anyway. Now, I've spoken about how to budget effectively. You can simply search up budget Ravi Sharma on YouTube and you'll find it there. But one of the easiest things that you can do right now to get started is look at your expenses over the last 3 months and look at the income that you actually earn. Then from there, you need to break down how much you're actually spending on needs and wants, and then how much you're investing or saving. You need that number of investing and saving to be as high as possible. And I've referenced the 50-30-20 rule before. 50% goes towards needs, and that would be like rent and groceries, 30% towards wants, and 20% goes towards savings and investing. I would like to flip it around and say 50% of your income should go towards saving and investing. And if you can save enough to then be able to go and invest, I would definitely go take that option above savings. Number 2 is map this out. You need a strategy here because we're not just talking about, hey, having some goals written on paper and then 12 months go by and you never achieve those New Year's resolutions. And then you go, well, no, this year is different. And you're going to go back and create goals again. You do that time and time again, only to then be disappointed by the end of the year. But in this case, you're talking about longer term. You're talking about 20 to 30 year plans. You need to be very crystal clear around the vision of what you want. If you actually want to retire early, you need to put that stuff down on paper. And it could sound silly, but by putting it on paper, the likelihood of you achieving it drastically improves. Now, I'm not going to quote stats because frankly, I don't have stats in front of me. It's a large percentage increase from those who write down their goals to actually achieving it versus those who don't write down their goals and they actually don't achieve it. And my final one for you to retire early is get into the right conversations with the right people. It astounds me that with so much information out there, there are still people out there making the dumbest decisions. Like financially, if you have to budget to make money to then invest, you need to take accountability and do it. If you feel like you don't make enough money, you need to find another job or find a second job to be able to invest enough. And if you do the moves early in your 20s and your 30s, you're going to find that it's a lot easier by the time you're 50 and 60. For the few that are listening to this and didn't have the opportunity to do it, or didn't take the opportunity to do it in your 20s and 30s, it's going to be a lot harder for you, but it's not impossible. That's why I urge you to have a strategy, talk to the right people, and budget, which is so simple right now. And if you're not doing it, you're in trouble. If you need any help at all when it comes to building out the strategy, when it comes to property, and you have enough there, but you have no idea what move to make next, I'm going to leave a link in the description box below. You can reach out to us at Search Property, and we not only find the property, but we also provide that strategy that you're going to need long term. So I hope you guys have enjoyed this video. If you have, smash that like button, subscribe if you haven't already, and I'll catch you guys in the next one. Thanks, guys.